Most people are hunting for the next 1000x stock, while I'm doing the complete opposite. I look for stocks that I'm comfortable owning in the long run, and then I get paid to buy them. And yes, you heard that correctly. If you're new here, I call out every single trade at the start of the week and then recap them all at the end of the week. And personally, I've been running this approach on stocks and indices consistently for 2 years with over a 50% gain per year. And I do this without having to stare at charts all day. So in this video, I'm going to break down exactly how I find these stocks, how I start with indices, lightly use fundamentals and earnings, and how I use cash secured puts and covered calls to build positions instead of chasing my entries. So starting with choosing indices, and this is the filter that most people will skip. Before I look into an individual stock, I just start with the indices. That's either going to be the NASDAQ or the S&P 500. If the S&P 500 and the NASDAQ are structurally healthy, higher highs and higher lows, and holding key levels, that tells me that the environment is supportive. If indices are weak or choppy, I'm not forcing trades, I'm collecting data and waiting. The key line here is I don't care about how good a stock looks if the index in itself is struggling. This will filter out a lot of the noise regardless before you even look at a stock pick at all. Now, this is the part that a lot of people are going to disagree with me with. We're looking for quality first, not hype. A lot of the stocks that I pick are stocks that people are not talking about online, and that is the way that I like it. Once the indices do look okay, I start to narrow down my universe down to a couple quality names. That means large cap leaders, real businesses, institutional ownership, deep options liquidity. Examples of this could be anything from Apple, Microsoft, Nvidia, Broadcom, Qualcomm. These aren't just moonshots, these are companies that have already survived multiple cycles. Now, with those being some big names, you can look at names outside the S&P 500 or the NASDAQ, like something like IREN. I'll use this as an example later in the video because this has been a great earner for me. All I'm saying is you basically want a stock that has survived multiple life cycles. You can understand how it has performed on the up and up, and especially when it's on the downtrend. Has it recovered? Does it still hold the fundamentals very closely? Has it still been able to turn a profit even in the worst of times? And like I said, yes, I do this with smaller names, but I do that with rules. IREN is a Bitcoin mining and data infrastructure company focused on low-cost renewable energy. As global demand for computing power increases, like AI, data centers, blockchain, energy-efficient infrastructure becomes way more valuable and not less. So I see improving earnings and guidance, strong revenue trends, and price that is not at euphoric highs. That will put something on my list if it is not inside an indice. Another great example of this would be SoFi Technologies. It is a fintech company. I'm a huge advocate for this company as well. As you can see, we have been ranging pretty hard in this, and I do have a current position of cash secured puts at this level right here at $25 because I would love to own more. This stock is actually rumored to be going into the S&P 500. I do believe the proposal was already sent for this. So this is a stock I'm kind of anticipating for it to jump into the S&P 500. So it does make me even more comfortable having this in my watch list and in my portfolio in the long run. I actually did have like a 25% gain in a matter of weeks. I did make a trade breakdown on that from before. And even with a stock like this that's trading at $26, that doesn't hinder the fact that it is a great company with great fundamentals, and that you can still make a great percent gain on this if you're playing this correctly. So as a pretty avid investor and trader now, there are a couple questions that I ask myself before I actually invest in a stock and will give me a great return in the long run. The questions are very simple. Does this business make sense long term? Are earnings improving or stabilizing? And is there real demand behind the company? If these answers line up, that is a great confluence for me to look into the company more. TradingView does have a pretty comprehensive way of looking at fundamentals on here. At the bottom, you can see a quick overview of the company. SoFi Technologies is a financial service platform which engages in the provision of student loan refinancing through the following segments: lending, technology platforms, and financial services. You can see its volatility curve, you can see its price targets, you can see analyst ratings, its technicals, performance as well, dividends and earnings. This is pretty important actually for a lot of companies. And this is not exactly the deep dive I would say that you should be having on a stock, but this does give a pretty comprehensive idea of which way a stock is trending if you're already familiar with it and you've already done your deep dive. I'm not going to bore you guys with an actual deep dive of these certain stocks, but if you guys want, I can make a separate video of deep diving a single company, maybe a company that you guys put in the comment section. I can do a full deep dive and show you guys how I actually choose that stock, either to be in my portfolio, my watch list, if I want to sell a cash secured put on it or a covered call. Just something to think about, but overall, we'll keep this one pretty light and understanding how to pick great quality picks for the future. Now, like I said, if those answers line up to be yes, that is a great confluence for me. Now, the next rule I have is probably the most important and keeps me the most consistent. Before I touch a stock, I ask myself one question. Would I be okay owning this stock for the next 10 years at the price I own it at right now? If yes, I proceed. If no, I will pass. This single rule removes so much panic, emotion, and forced decisions. This helps me identify very quickly if this is just going to be a hype play, if I'm chasing a premium on the option side of things, or if I'm just being greedy in a certain week and wanting to have more positions. If I'm not comfortable owning a stock for the foreseeable future, that shouldn't be in my portfolio at any time. Now, obviously, that can change with stocks being, ever adapting beings. And personally, if there ever is a time where I say, hey, I'm in a position, I don't like the fundamentals of this company anymore, I don't like the direction that they're taking it, something has gone sideways, I will exit that position either at a loss or a break even. I will have a strategic angle to play there. But overall, asking yourself this before even putting something in your watch list is very, very key to stay consistent, and it filters out a lot of that greed that traders can have. So if we hop over to Apple, we can see that Apple has slid around 14% from their highs and have been trading a lot lower. We're trading in the 250 area right now when we were at the 286 level, almost at 290s. Everyone can say, oh my God, Apple is crashing. We're looking like we're going to be bearish for the next while. But in 10 years, do you think Apple will still be kicking and innovating? Of course they are. Everybody and their cousin has an iPhone. We're almost programmed to the point where if somebody has a Samsung, we almost look down on them. Apple has such a strong hold on ecosystems from iPhones to at-home entertainment, cellular. So for someone to say that Apple will not be around in 10 years would either have inside information or they would be kidding. Now, that is just my personal opinion on this and this stock. And obviously, you have to do your own research for anything that you touch in the stock market. But personally, for me, this is a stock I would be very happy owning in the long run, especially at a 14% discount from where it was trading at. But am I going to just place a market order right here? Absolutely not. I never buy stocks with market orders. Instead, if I want to own a stock, I always sell a cash-secured put. A cash-secured put, explained simply, is just a paid limit order. I choose a price that I want to buy at, and the market pays me a premium for making that promise. For example, if Apple is trading at 250 and I want to buy it at 245, I can sell a cash-secured put at 245 and I get paid immediately for that. Again, you're just making a promise to buy 100 shares. Obviously, with Apple, that is going to be around $25,000 because we have $250 per share times 100 shares equals 25. So obviously, you're going to have to set aside $25,000 in capital to do this. Options always are used in terms of contracts, one contract being 100 shares. So again, this only works if you're buying 100 shares of a company. Some of you may not have $25,000 in a portfolio to do this with, and even if you did, and that's your entire portfolio, you're putting your eggs in one basket. That's why I stay pretty consistent with keeping a wide basket of stocks. Something like IREN trading at $53 a share, which is a stock that, like I've said, I love many times. You can pick this up for $5,300. So even if you have a $20,000 portfolio, you are tying up about 25% of your portfolio in this stock, but that is more diversified compared to just putting all your eggs in one basket. Again, a $20 stock, you would need $2,000 to do this with. A $50 stock, you would need $5,000 to do this with. And a $200 stock, you're going to need $20,000 to do this with. This is why stock selection matters so much. If you're tying up capital, it has to be quality. So going back to Apple, if we made that cash-secured put agreement to buy at $25, it can expire at the end of the week, it can expire at the end of the month, it can expire 2 months from now. You choose that, and that does affect how much you are paid. Now, if I'm running a weekly premium, I like to aim for 1% per week. So in this case, I would have to make $245 to make this make sense. If I'm not getting paid that premium, it doesn't make sense for me to do this, because if I'm aiming for an aggressive 1% a week, that's what I need to actually achieve this. Now, obviously, this is going to be different for a lot of people depending on what they're targeting for the year, the month, and so on and so forth. But for me, with me targeting around 1% and over per week, I have to be pretty aggressive with this. But assuming we put in the cash-secured put, if Apple is trading above that 245 mark, we just keep that premium. If that expires worthless, we've kept that $245 and walked away with it clean. But if Apple does come below that price that we've set at 245, we keep this $245 in premium, and we also pick up the shares at a discount. So yes, you are kind of catching that falling knife there if Apple is continuously falling. But now you've not only grabbed it at a 14% discount off the highs, you've probably grabbed it at a discount from here. We can actually check from where it's trading to 245, another almost 2.5%, 3%. So you could put that strike price a little bit lower to make it around 5%. That's kind of where I'm comfortable doing that with. 5% and below, picking up a stock from where it's currently trading at, especially if it's off its highs, you're catching that at such a discount, and it makes so much sense to own it at a price like that. So instead of setting a limit order on a stock where you just say, hey, like I'll, buy 100 shares of the stock at $245, you sell a cash secured put and actually get paid to set this limit order in the first place. So opting over to a company like SoFi, because Apple trading at $250 a share means we need around $25,000 to do it. But SoFi, when we're trading at only at $26 a share, we only need $2,600 to play this. So in a case like this, I sold a cash secured put at $25, meaning I agreed to buy 100 shares if SoFi drops to this level. From where it's currently trading at, we would have to drop around 4% just to assign myself those shares. Now, I've probably tried to pick up around 300 shares at this level, meaning I have set aside around $7,500 in my portfolio to buy 300 shares at this level. But this is a stock that I want to own. As you can see, we are trading 25% off the highs from the current price. And if we did assign myself there, I would grab it at almost a 30% discount. And if this is a stock that I believe in the long run, something that's getting put into the S&P, I would see this going a lot higher. So this would be something where I could own the shares here. I could sell covered calls all the way up, meaning I'm agreeing to sell the shares at a higher price and getting paid that premium to do so. And I can do it in a way where I'm getting paid all the way up and not even having to get rid of those shares if I play it smart. And then ultimately, once I'm very much in the money on those shares, up on a good stock gain, I can sell one covered call that immediately takes me out with a giant premium. And like I said, if I get assigned, that is not failure. That is just part of the plan for me. I'm just going to be selling covered calls at prices that I'm happy at. And I start getting very reactive to either I want to keep these shares or I want to just keep collecting premiums on them. Now I'm earning a premium on the upside after earning a premium going to the downside. I'm participating in all the stocks upside and I get paid to exit the trade at the end of this. And I think the biggest part that I haven't even mentioned yet is I'm not even trading every single day. I'm just watching earnings, I'm tracking headlines, I'm monitoring my positions maybe a couple times a week. Swing trades happen maybe once or twice a month, but options run quietly in the background without much maintenance required. So for a quick checklist on how to actually pick a quality stock that you'd be comfortable owning, this is what I would actually use. 1. Indices structurally being aligned. 2. A quality company being a large or selective smaller name. 3. Earnings and fundamentals actually make sense. Like I said, we can do a deep dive video on earnings and fundamentals to show you guys what that actually looks like. I am assuming that you guys kind of know what that is already and just showing you guys how you can actually use this to your advantage. 4. Be comfortable with owning 100 shares. I know that sounds like a lot, and that is for some stocks particularly, but that is the only way to play this game profitably. 5. Entry via a cash secured put only. There is nothing stupider than putting a limit price on a stock that you want to own unless you're not planning to do it this way. I really don't see a need to ever just buy at market price. That is kind of just for noob investors. If you're trying to be a pro investor, only use cash secured puts. And then 6, you can exit via a covered call. And I want to point out that this is not a fast, flashy strategy. This is just for consistent gains in the markets. If you stop chasing the next big thing and start getting paid to wait, everything will change. If you guys want, drop a stock in the comments that you'd actually want to own, and then we can actually make a separate video showcasing the structure I'd use to approach it and see if I would want to sell a cash secured put, at what level, and where I'd want to exit it, and everything about it. But if you guys found value in this video, make sure to leave a like, subscribe, and we'll see you guys in the next one.